so much of planning is navigating the tax code.
And it changes. And it's not getting any easier, by the way.
It's getting more complicated.
Yes.
And so part of it is like, what's our objective? What are we trying to accomplish? Then how do we navigate through the tax law to give us the greatest possibility for success? That's really what it comes down to. Financial markets are just one piece. Navigating the whole tax code is complete other piece.
I was thinking about this the other day. Why do they let part of your required minimum distribution go directly to charity as a qualified charitable?
Why? Why you're putting questions to the tax? Why?
But why part of the RMD? Why not before the RMD? Why can't you do it when you're 65? Why do you have to wait till your required minimum distribution? My guess is in our lifetime they are going to change tax code so that you can actually give away part of your IRAs to a charity prior to required minimum distributions.
Or they won't allow it anymore. I mean, my bet is in my lifetime, the money you leave in a 401k or an IRA to a charity will be somewhat taxable. That would be my.
All right. Well, we'll wait and see. But the point being is the tax code is ever changing.
We'll wait and see. So when you do your planning, part of it is what is the current tax code? And part of it is what's your best guess on what you think the future is going to be?
And how do we mitigate against that?
And if you would have asked people 10 years ago, 15 years ago, if you thought tax rates were going to be where they are today, I know this because I've had conversations with people. Tax rates are only going up, so let's plan this, that. They haven't. They're lower today than they were 15
The only
years
thing
ago.
that's going up is the deficit.
Correct, which that'll hit a tipping point.
We've been saying that for years. It will hit a tipping point, though, at some point in time.
So one thing that hits us, and we're talking about the tax code here, and we'll take some calls here in a moment. And this impacts anyone who's 50 and older who's still working and contributing to retirement accounts. So I think you probably saw this provision, Pat. A new rule requires any workers making $150,000 or more to put a portion of their 401k contributions into the Roth, not a pre-tax.
Saw that.
So they're limiting on how much
your deduction.
And this went into effect January 1st of this year. And so not all 401ks offer Roths, most do. But going now, the catch-up contributions must go to, if you're making $150,000 or more, it must go to the Roth.
So my point, things become much more complicated. The idea of simplifying the tax code is absolutely out the window. No one even talks about it anymore.
This applies to 401ks, 403bs, 457s. So if you're over 50 and you've got the $8,000 extra you can put in as a catch-up, then you can no longer get that tax deduction.
It has to go into the Roth side. I wonder what happens if you have multiple plans. What if you have a 401k?
You're still limited.
A 401k and a 457, you're still limited.
It's the catch-up.
It's just the catch-up provision. Yep.
But if you had 3 employers, you can't maximize the 401k in each. The annual limits are the annual limits combined.
But not the 457 401k.
457 is because it's not a salary deferral. It's not quite the same.
Not a qualified plan.
It's not. That's exactly right. What the heck is it then? Looks like a qualified plan.
Acts
like a qualified plan, but we call it something different, so it has different rules. But this is. Yeah, so I mean, anyone who's over making
your employer will actually notify you of that, though. Your plan administrator will.
Yeah, but it's just one of those things that
it's just one more. Where last year it would actually lower your taxable income, and this year it will not.
So there's a couple ways why. I mean, there's some things that have hurt higher income people this year. That's one. The second is on charitable contributions. You no longer get a full deduction. You're limited. It's a 0.5% of your adjusted gross income. It has to be above it's somewhere right in here. It has to be above 0.5 percent of your adjusted gross income before you start getting the deduction. And then it's capped at, the tax deduction is only at, was it 34%, 35% instead of 37%?
Which
they monkeyed with you. It's negligible.
It applies to very few.
It's negligible.
But it's there.
No, it applies to anyone.
No, understand that the cap isn't going to affect that many people.
That's correct. But those that, where the most of the charitable dollars come from, that's
rich people.
Okay, whatever. You call them whatever you want. Okay. I don't know. Is a rich person someone making $160,000 a year that can no longer put the catch-up provision to their 401k?
That is not.
Well, according to this, they're rich. Which is why you hear us talk about things like, when doing your planning, don't expect that the current tax law, here's some things that could change. We could see a Roth withdrawal be somewhat taxable. We could see an excise tax. They had that, not that. When I entered in this industry, they had excess withdrawals.
You could see a consumption tax.
You could see a consumption, yeah,
which would be a regressive.
We could see a value-added tax, consumption tax, and a reduction in income taxes. That's a possibility. But there's a lot of possibilities.
That's regressive, and our tax code has a tendency to be progressive. That would be a big change.
It's not.
Look, but they do it. They do it in Europe. You have both.
That's right. You have both. So in your planning,
you have a regressive side of the tax, which is a consumption tax, and then you have an income tax, which is progressive. You have both of them in Europe.
Yeah,
parts of Europe.
That's right. I think all the EU has the.
I can't speak to all of it.
I don't really care to be the expert on. But they have the value-added tax. I don't know if there's much value added to the tax. And here we have in California this proposition where they want billionaires to take 5% of their net worth.
One time.
One time.
I'm sure it'll only be once.
And you see how it's calculated. It's not necessarily on your net worth. It's voting shares. So you're a founder of some large company. You have to calculate your net worth based upon what percentage of the company do you have for voting shares. So like the founders of Google, maybe they own 3 or 4% of the company, but their voting shares are 30%. So if that hit them,
it's not going to fly in court.
The founders left California at the end of last year.
The tax could be actually more than their net worth.
Correct. In this case, it would be half their tax.
And look, we're not beating on the system that got them rich. They should pay taxes. The question is, should they pay taxes in a manner that allows them to continue to pay taxes in the future?
Or are we gonna have a tax now where we start confiscating people's wealth?
Yeah. And they do have I spent some time in Norway and I have some relatives in Norway, and they have a tax where they tax you on unrealized gains. So you borrow the money from the banks. I have a niece that works for a bank. To pay your taxes. And so that's why startups leave Norway, is because once they're up and running, the tax structure is such that... Anyway. All right,
the point is, when you do your planning, we got to pay attention to current taxes. And then when we start thinking 10, 20, 30 years, we have to run a lot of these different what ifs and make an informed choice. And in a perfect situation, you get down the road and you've got money saved in different types of buckets, different areas. It gives you flexibility when it comes to your planning. Someone moves into retirement today. They have $3 million in their 401k, a paid off house, and nothing else. There's not a lot of planning to be done then. Right. And when it's time to buy a new car, they got to take the money out of their 401k, pay the taxes on it, sometimes push them into a higher tax rate. If instead you enter retirement, you've got $1 million, 1.5 in your 401k, 500,000 in your Roth, $1 million in brokerage account, or maybe 500,000 in brokerage, $500,000 rental house or whatnot. The more
diversified the asset location, the more choices you have in the distribution.
Yeah.